Thank you for watching the Housing Oregon YouTube channel. Be sure to join our network and get involved in the work that we are doing. If you can, please like and subscribe. It helps us build this channel, which serves as a platform to communicate with our members. This video is part of our 2025 annual conference. We're looking for folks to be on the conference planning committee. Please email info@housingoregon.org.
All right. Hello, everyone. We're going to get started right on the dot because I think we have a lot of talkers on this panel, myself included. So we want to make sure we get all the information out to you all. My name is Bartos-O'Neill. I work for Orrick, Harrington, and Sutcliffe, and we primarily do a lot of the bond counsel work for our conduit affordable housing bond financings, primarily with Oregon Housing and Community Services. I've been working for Orrick for the past couple of years, and with me on this panel is Mike Schrader, who maybe has been working on these deals for longer than I am old. Maybe. But all that to say that means is Mike has a deep well of knowledge to share with you all. With us, we also have Hattie, who is the Housing Production Manager for Oregon Housing and Community Services. I'm sure a lot of you already know Hattie. Hattie is one of the key contacts and players at Oregon Housing and Community Services for getting all of those affordable housing projects financed and worked out. We also have with us Robin, who is with BLX Group Services. BLX, and Robin, correct me if I'm wrong on this, is both a fintech and municipal advisory company. Is that right? And you all do a lot of things: continuing disclosure, swap monitoring, bond proceeds investment, and then your specialty, arbitrage and rebate, which you'll be talking about today. Okay, this is the Tax-Driven Opportunities and Obligations in Affordable Housing panel. This is our general overview. We're going to be starting by talking about opportunities. That's going to be some tax-exempt bonding alternatives. That includes recycled cap, as well as 501c3 bonds and governmental bonds. We might touch a little bit on the 25% test, which is going to be enacted in 2026. And then afterwards, we're going to talk a little bit about obligations that are tax-driven. These are in relation to related party transactions, a little bit on reissuance and conversion, as well as arbitrage and compliance. All right. Let's start with those tax-exempt bond alternatives. All right. Mike, do you want to do a bit of an overview of where we're at, sort of volume cap wise currently, and then make that transition into recycled cap?
Glad to do so. Is this on? Yep. Okay, it's on. Very good. Well, good to see so many of you. I see many of you who I see on Zooms on a regular basis as well. So great to be here. Great to be here today and talk a little bit about this. As we talked about this panel, we really wanted to again, focus on opportunities and obligations and talk about both of those things as well. I think as you all know, there's been panels on the 25% LIHTC test. Angie, can you hear me now? Okay, I will talk right into the microphone. Thank you.
Mic technique. Yeah.
Okay, mic on mic. Okay, very good. All right, very good. So the 25% LIHTC test is really going to be a game changer on this. But I think as all of you know, the conduit program at OHCS and other conduit issuances for affordable housing projects with low-income housing tax credits have been driven by the availability of private activity bond volume cap, requiring a 50% test, meaning basically half your project costs have to be financed with tax-exempt bonds, and we can get into the weeds on that. But lowering that to 25%, as you can see, is a real game changer as well on this. And I think, among other things, is we see what projects are paying down to at conversion with their perm debt. We suspect that a 25 or 30% test is going to cover all or most of your long-term debt. And, of course, that frees up a significant amount of private activity bond volume cap. Our friends at OHCS are working on, I know I've seen a draft in terms of new policy around private activity bond cap allocation, but again, the 25% test will be a huge game changer in terms of the availability of private activity bond volume cap, and with it 4% tax credits. Then, of course, the question becomes, well, what other gap resources do I have? You guys all know the math and numbers around doing affordable housing work on this. So a little bit of this is, certainly modified and changed significantly by having a 25% test effective January 1. I think there is certainly discussion in other jurisdictions about how you preserve some volume cap, and maybe you do some of your issuance this year and then move into a 25% test in 2026. I think based on the deals that are in the queue right now and some of the hard tax issues around bifurcated issuance, I suspect we're not going to see any of that in Oregon. Basically you can't have a final pro forma and do a bifurcated issuance to cross over the 25% threshold on that. And I don't think there's a whole lot else we need to say about the 25% test on this. I do think we've done a couple recycled cap deals in Oregon on this. I think there's still an open debate as to whether they're worth the time and challenge and cost and expense on it. But the recycled cap deals can be a valuable tool, and I think they can continue to be a valuable tool if your project can sustain significantly higher debt, tax-exempt debt, permanent debt, than a 25 or 30% amount required for your LIHTC purposes. So I think there is still some value there. It's still probably a window of opportunity for recycled cap projects, and we certainly have had some interest in terms of acquisition rehab projects where you can use recycled cap and otherwise. But let me talk just really briefly what's recycled cap. Under the current regime, as I said, you've got a 50% LIHTC test. That almost always means you have to pay your bonds down to a permanent amount at conversion. That short-term amount of bonds, you can take the volume cap from those bonds that are being paid down or paid off at conversion. And if you do and check the right boxes on that, you can take that volume cap and apply that to tax-exempt debt for a completely, entirely different project. So it's a way to generate long-term tax-exempt with private ownership of the property, which means you can bring in private traditional equity into your project as well. The trick here on these projects, and different jurisdictions have different rules about how you, quote, capture this cap to be recycled. There's really two ways to do it. One is you close your new deal on the same day that your other deal is converting. That's a little hard to do that. If you control your own cap, you can do it, and it's been done. The other way is to do a warehouse facility, and now you basically do a cash collateral note, and then you've got some flexibility when you roll your cap into your new bond issuance, and we've done that recently as well. Again, I think in Oregon, the jury's still out in terms of whether either of those deals are worth the pain and suffering. But again, it's interest cost savings. There's transaction costs associated with as well. But I think there will continue to be opportunities to potentially use recycled cap even in a 25% test environment. So that's what recycled cap is, how you capture the cap. Again, two options there. Hattie, do you want to talk about the department's support of recycled cap before I get into the other weeds?
Yeah, absolutely. Thank you, Mike. Just checking. Angie, you got me? Okay, good. Just checking the back of the room there. So yeah, we are absolutely in support of using strategies to bring additional funding options to your projects. We know gap funding is only going to go so far, and we know tax credit yield is, let's face it, not really where we want it to be, not where it was when I started doing this work in 2020. So yes, if you have an opportunity, your project can support looking at recycled cap. I just want to be clear, OHCS does not currently have a recycling program per se, but if you come to us with a project strategy to bring that in and you can warehouse, or maybe you have a project that is converting that you can do the recycling, which was challenging, but it worked. We are on board to listen to those proposals and see what we can do with that. It's kind of outside of the ORCA, because your project is already, good word, Becky, ORCA adjacent. So, But yes, we all know we have to do things a little differently in this market. And I will say also, we have a 501c3 issuance that's going through right now. Again, learning lots of good stuff on that one, working with our bond counsel to get through. We're open to hearing your ideas if you come to us with different solutions.
And again, these are simply tools to create long-term tax-exempt debt for your project. Certainly, again, we hope we're not volume cap constrained like we have been, but certainly opportunities around that. So again, the recycled cap, we've got the rules up there in terms of how it actually works, but it's just, again, it's a new tax-exempt bond issuance. And again, the magic's really in just bringing the cap from the old deal to the new deal. All the same rules apply. We've spent, I think last year, or year before, I think we did a whole panel on 501c3 bonds. As Hattie noted, we've got an active project underway right now. The 501c3 nonprofit issuance is now a formal part of the OHCS conduit issuance program. It's all set up, so if you're a 501c3, your exempt purpose is in affordable housing, you can issue through the OHCS conduit program on that. Again, 501c3 bond gets you long-term tax-exempt interest. It doesn't generate LIHTC, but again, it's a path to tax exemption, which can be very significant. Working with some folks in the room right now on one particular very interesting 501c3 project issuance right now. One of the things with a 501c3 bond, just to sort of get back to the real basics here, first of all, it has to be 100% owned by the 501c3. So other forms of equity simply don't work. It's got to be 100% ownership. Any soft debt has to be real debt, or it doesn't work because, again, 100% ownership by the nonprofit on this. There's ways to structure that subordinate debt in ways that pass tax muster on that. One of the more interesting applications of 501c3 bonds, again, if you're issuing a 501c3 bond, you're issuing tax-exempt debt pursuant and in fulfillment and furtherance of your exempt purpose. If you're an affordable housing developer, that's pretty simple. You're building affordable housing. So what happens about middle or workforce housing projects? Well, there's a theory called lessening the burdens of government. And so if you're a nonprofit or you formed a nonprofit and you're holding hands with your local jurisdiction about the need for workforce or middle housing in your community, we've recently formed some 501c3s under a lessening the burdens of government theory. That relationship with your local government and lessening the burdens has to be real and substantive, or you will not get your exemption letter. But when it is real and substantive, and we're talking about real public-private partnerships, it's another path which gives you a lot more flexibility to issue 501c3 tax-exempt debt for projects that serve a broader range of incomes. We've done one project with up to, I think, 140%. We're typically around the 80 to 120 as we look at sort of middle income housing, particularly outside major metro areas on that. So again, it's a fascinating place in terms of developments, in terms of tax-exempt debt, and some more flexible structures using 501c3 bonds. And again, OHCS, it's standard part of their conduit program. We've focused just on 80% and below so far at OHCS, but again, there's a wide range of opportunities to use and deploy 501c3 obligations. The other opportunity, we don't talk a lot about this, but certain governments like housing authorities can issue governmental bonds, and we haven't seen this in Oregon, but it's certainly something we can explore in terms of straight up governmental bonds for housing projects. So again, thinking about tax exemption, tax-exempt debt, we've got the traditional private activity bond allocation, direct allocation of volume cap, recycled cap, alternative path 501c3 bonds, and also the alternative path of direct governmental ownership, which we've seen in a number of jurisdictions as well. So those are kind of the basic options around tax-exempt. So Alex, let me pass it back to you.
Yeah, one thing that I wanted to highlight before we move on to our next slide, not to throw a wrench and make things even more complicated and confusing, but when I was chatting with our colleague from California, Paul Tolan, who's up here in the front, earlier today, I realized you can actually combine your regular volume cap deals with recycled cap as well. So you can have both of those. You don't necessarily need to have your deal be 100% recycled cap. Now, that adds some complications, of course, but it is a possibility. Okay, Mike, you already talked about the 25% test a little bit, but anything else you want to add? And then Hattie, perhaps anything from you on the 25%
I'm just going to
test?
look for Hattie to add anything, because I know there's been whole sessions and crystal ball gazing about LIHTC pricing and otherwise. So Hattie?
Yeah, thank you. So I just want to be clear too. 25% test does not mean you structure your project at 25%. We want to make sure we've got a cushion. I don't ever want to see a project again. I've had to deal with it once that did not meet the 50% test, and it was ugly, and we had a whole lot of pain trying to figure that out. So we're looking at 30, 35%. And if you've got projects in the pipeline right now that were structured at 55% but are looking to close in 26, and the lender or investor are coming back to you saying, oh, we don't necessarily need to do 55, but you want to do a little bit more cushion, just talk to us about that, and we can look at the 40% range or maybe the 45% range. So we're open to exploring opportunities that way as well. Want to talk just for a minute about the LIHTC aspect. Do you want me to talk about that now, Mike? Okay. Just bumping ahead just a little bit to the conversion process. So conversion used to happen, and production analysts would get this call like, yeah, we converted, hooray. And now we're like, oh, okay, that was great. Now we need to understand what's happening, because conversion is no longer just we signed the final documents and the perm lender's in place and we're all good. It's we got lease up problems, we got stabilization issues, we got a gap, we weren't able to fill all the things, our perm lender couldn't come back with the amount of debt that they thought that they could underwrite for us. All of those pieces. So I'm saying, tell us, loop us in as soon as possible. If your project is all going to have a production analyst assigned, didn't say that very well. All of the projects are going to have a production analyst assigned. Reach out to them before you start your conversion calls, get them in the loop, and then also loop in bond counsel. We want to make sure that we are taking into account any challenges that we could have in the project.
And more to come on that topic after I give you a little brief on some related party considerations. These happen more often up front. Alex?
Well, I was going to actually say, before we head into perhaps some obligations that we should keep track of, and let's stay in positive opportunity land for just a few more minutes and potentially open the floor up to anyone who has some questions on those opportunities. If you want to hold on to them till the end, that's totally fine too. But while it was still fresh, I thought I'd ask. Okay, I think you're ready for the rest of the presentation then.
All right, let's talk about related party considerations. And this is where I channel my inner tax lawyer. Alex and I are both bond lawyers, to be distinguished from tax counsel, who we have a few of those at Orrick as well. So this is when I channel my inner tax lawyer. So Paul, you're not a tax lawyer, but you could kick me under the table if I'm not channeling some of our colleagues correctly here. Okay, related party transactions. When we get started on these deals, we'll ask some questions here, and I want to give you a little background about why we ask some of the questions we do up front. And this goes to sort of tax compliance issues as well. They're under related party consideration. I really want to talk about really just two scenarios that we see on a regular and recurring basis. And again, it's the tax code. So related parties, there are all sorts of issues around related parties, but I want to focus on just two right now. The first one is you come to us with a transaction and your favorite bankers say, gosh, I can purchase your bonds and I can give you a screaming deal on your tax credits as well. And you go, great, one-stop shopping, isn't that terrific? Well, it might be a problem. So the first thing we do when we have, now generally, and this goes to some technical tax issues on this, I won't bore you with all the details on it. Generally, the issuer's fees are not a problem, are not problematic, except when you come to us with related parties. And there's some technical rules as to why this is a problem. But again, if you come to OHCS and you say, okay, I got this one-stop shop deal, I've got a screaming interest rate on my construction loan, I've got great pricing on my LIHTC, and it's the same party. The first thing we have to do is we have to run what's called a yield computation, because this means that the spread, this is what we call a yield spread limit, can't be more than 1/8 of 1%. So it just squishes this fee. And again, there's some technical reasons for it which aren't completely logical, but we have to do the math and see if it works. If it works, that's great. What it typically means, if it works, because we have to do this computation, and the computation is fairly tight, what that typically means is you're going to have some kind of a draw, and you've got a drawdown structure. We're going to give you an attachment to your indenture that says, I will draw not less than, no later than, the following schedule. And if you do that, then our computation is right and it works and all is well with the IRS. When you call us a year or year and a half in and you say, you know, that bond interest was kind of expensive, and so I forgot I was supposed to draw down my bonds on that schedule, you just ran the risk of having a taxable bond. And we all scramble to figure out what the computation is. And so be careful on that. So this is this yield spread limit on it. The other scenario where we can have problems, so that's the related party, borrower, a bondholder, and investor are the same party. Now, they might have the same name. We look at the org chart. If the LIHTC investor, if it's a syndicated deal, then we sort of look up the organizational chart. We see if the parties are really related or not, kick the tires and make sure that they're not related. So if you have that scenario, there's a couple workarounds if we can't get the yield computation to work. The workaround is not to go to OHCS and say, will you just bond issue for nothing or next to nothing because Hattie actually pay her bills too? And the state does that. So please don't come and ask the state to not charge their issuance fee on that. And that's happened not recently, but when somebody forgot to tell us who was in the org chart. And anyway, so don't do that. Let's get that full disclosure out there, do the math and figure it out. There's a couple workarounds for that. One is if you have a different construction lender or construction lender bondholder than your permanent lender, it may be possible for your permanent lender to come in with a $50,000 initial advance and then take out the construction loan before conversion. So basically, we call this a senior subordinate structure. So basically, your construction lender, who is going to be your construction bondholder, becomes a direct construction lender, does not purchase the tax-exempt bond, simply funds the construction loan directly. Your bondholder, your permanent lender, comes in for a little bit amount up front and then takes out the construction loan before conversion. I call that a senior subordinate structure. That works if you've got a different perm lender from your construction lender. The other way to do this potentially is to just really shake it up and do a cash collateral bond where, again, the principle is that you have different construction and perm lenders, and you just make sure that your construction lender, that your bondholder, who's also your tax credit investor, does not at any time actually hold the bonds, and that eliminates the related party problem as well. The other issue when I'm talking about yield spread is not a related party problem, but it's something you have to be careful with, and I'll just mention it here, is if you have a construction-only drawdown bond, that's subject to a 1.5% spread limit as well. And again, this is a scenario where you need to do the math, make sure you understand what your draws are. Again, you might have a bunch of sources, and you want to draw your bonds down in a very small amount up front, the minimum amount more than $50,000, hence that, you got to draw $55,000 up front or $50,001. That's a technical tax issue, so your bonds are, quote, issued on that. And then you want to draw down your bonds later because your bonds might be your most expensive debt in the capital stack, so to speak. So you push those out. Well, if you push that out too far, then your yield computation might not support the 1.5% spread. So again, particularly in a drawdown construction only bond, you'll want to do a yield spread computation there as well. But again, all those things are technical issues. Call us, we'll walk you through them. I think most of you are sensitive to those things as well. The other item I'd like to just mention in terms of related parties comes with a scenario where you've got a seller note. And there's not a whole lot I want to say here. It's a fairly technical scenario, but again, it's a different kind of related party transaction where if you've got an affiliate, if you own a project, particularly in our acquisition rehab project, and part of your capital stack is a seller take back note, that note has to be real debt. Because remember, you sold 99.9% of your equity interest to your LIHTC investor. So if you've got a seller note that's not really debt and it's a related party, guess what? It's equity. That's a problem because you thought you sold all your equity to your LIHTC investor. Okay, so just another scenario, just some sensitivities there. There's some hoops we have to jump through and some check the boxes in terms of who's giving it a true debt opinion and so forth on that. So those are really the two related party issues that I think occur most frequently that we see. They're all manageable. There's always workarounds on that, but having early conversations on that as part of our intake and questionnaires on that, we'll be asking you those questions on that. So that's really what I wanted to cover today in terms of related parties. There's lots of other things. One of the other wrinkles on a related party, if you've got a related party and you bought the property from them and they're a related party, it doesn't, and you spend money on the acquisition, it's not a, if you spend your bond proceeds on a related party, it's not an expenditure, so you can never meet your 95.5 test. So there's just a host of issues around these to just be careful with in terms of what your org chart looks like, who's on first, and again, we'll all channel our inner tax lawyers to make sure we're checking all the boxes on those things. But just some things to be careful on as you're structuring your deal. Alex?
And Mike, not to put you on the spot, but for those of us in the room who might not know what this mystical 95.5 test is. Uh-oh.
Okay. I'm going to channel my inner. So when your bond proceeds have to be spent on your tax-exempt bond proceeds, not your taxable, but your tax-exempt bond proceeds, a 95.5 test. Sorry for all the shorthand. I have been doing this longer than Alex has been alive, so full disclosure. You have to spend your tax-exempt proceeds, 95% of your tax-exempt proceeds need to be spent on qualified capital costs. And that's fairly generous, and it's usually not a problem because you've got tax credit equity, you've got gap funding, you've got other sources. So typically you just want to allocate 100% of your tax-exempt bond proceeds to your good costs. And again, that's an allocation exercise. It's not you have to tie a string around the money and put it in a separate account. It's an allocation exercise that's part of your tax certificate on that. And so while it's a 95.5 test and you have 5% bad costs, allocate it 100% to good costs, and then you typically don't have a problem.
Thank you, Mike. All right, our next topic is conversion and tax reissuance. And Hattie, I was hoping we could start with you to sort of talk about the life cycle of a bond. And you touched on this a little bit earlier where it used to be in the past, hey, they called you, it converted, woohoo! But now that's not the case anymore. What's it been looking like lately?
Yeah, that's a really good question, Alex. We've been seeing a lot of things on deals lately. We're seeing a lot of conversations where, hey, we got a lot of one bedrooms and studios and we can't lease those up. So we got a problem. It's like, yeah, you got a problem. We all have a problem. We'll get units in and they've got rent collection issues. Well, that's a problem too, because, as part of your conversion, you have to reach your stabilized occupancy. That's not going to help you get into that situation. So also, as I mentioned before, the words we don't like to hear are, project costs more than we thought it was going to cost to build, and we have a gap, and we've asked everybody else, and we're asking OHCS for funding. Well, if you have been in any other sessions, our funding is extremely limited right now in what we have, so chances are pretty slim that we're going to have any resources to be able to help out. So those are all reasons that you need to connect with us. When we're looking at the LIHTC aspect of a deal and the bond aspect of a deal, though they are related, they are two completely separate items. Final applications need to come in within 6 months of your placed in service date. Often we're seeing those coming a little bit late. We understand that there are challenges, but once your cost cert is final, we can draft your 8609 so that everybody can take a look. And usually that is a key trigger point for getting one of your equity installments from your investor. So you need cash to come into the project, submit your final application, get your draft 8609s, then you have money to start talking about, okay, this is our funds available for conversion. As soon as we get that application and it's considered complete, OHCS can turn around within usually 30 to 45 days, your draft 8609 forms for you. So we do really work to try to get those out as soon as possible. And again, if it happens in conjunction with conversion, that's great. We can record all at the same time. If not, and we need to do the 8609s and the declaration for your tax credits ahead of time and then work on conversion, we can do that as well.
Great. Thank you, Hattie. Very similarly on the bond side, if everything is going smoothly with your project and it's on track for conversion, we don't really have much of a role as bond counsel. We do like to hear about it because sometimes there are built-in conditions in the bond documents that require a no adverse tax effect opinion from us, and your lenders will probably be looking for that. But otherwise, where we often will like to hear about your progress and where you are on your journey to conversion is if there are any potential roadblocks. And I'll get into that on the next slide. But also, I wanted to maybe get a preview from you, Robin, about how you like to hear about conversion as well, as it relates to arbitrage and rebate.
So when you have a conversion, it may or may not impact your arbitrage. So on an annual basis, no matter what, I will send an email to my clients and ask, have you restructured your bonds in any way? Oftentimes I'll get a reply back, oh, yes, we did a conversion 6 months ago. Well, as you'll learn under the arbitrage section, if you reissue your bonds, that is considered a final calculation for arbitrage, and if you owed a payment, it was due within 60 days of that conversion date. So right out of the chute, you're late. Now, generally, so far that has not been a problem with anybody that I've come across this with, but you don't want to be that one that is the problem. So, one of the main takeaways, I'll probably mention this like 3 or 4 times when I talk, is if you have any structural change and you need to contact your arbitrage analyst and say, does this impact my arbitrage? Let us do the research and figure out whether or not that conversion sparked a technical reissuance. And I just looking at it, I keep going back with Alex saying, how do I know? And she's like, good luck, ask us. And so it's not just something cut and dry that you might just automatically say, oh, this conversion is a reissuance, call Robin and she'll take care of it. It's an unknown. So I would much rather hear about it earlier than later.
Thank you for that preview. Yeah, basically the summary of this whole section is please call us, email us to let us know so we can issue spot, some potential pitfalls and make sure everything goes smoothly with your deal. The restructuring bit that Robin mentioned is, that ties into a tax reissuance. And basically that occurs when there are any material modifications to the original terms of your bonds. That could potentially trigger a tax reissuance. And if we don't jump through the necessary tax hoops for that, what that means is that your bonds are taxable. And we really, really don't want that for any of your projects. A really common example of a modification is say that the bond documents or the bank documents have January 1, 2025 as the set conversion date, the outside conversion date for your bonds. Oftentimes, with everything that's going on, you might need a little bit more time. That's normal. At this point, it's normal. And you decide to go chat with your bank and do a 6-month extension of that date that you didn't originally contemplate at the beginning of when your bonds close, say 2 or 3 years prior. That's something please tell us about, because that most likely will trigger a reissuance. And when you reach out to me or somebody else from the Orrick team or whoever your bond counsel is for your deal, we'll ask a couple of questions. One, how long the actual extension is. We often see 6 months, but sometimes it's only 1 month, and that might be a little bit better because Barbara, tax counsel, can do some math magic and figure it all out to make sure it doesn't trigger a reissuance. Another thing we'll ask is whether or not your project has been placed in service. This is mostly a LIHTC counsel issue, but we try to track it as well because we don't want to trigger a reissuance on your deal before the project has been placed in service because that can impact the tax credits. Another question that we ask, oh yes.
It doesn't just impact your tax credits, it means you don't have tax credits.
I was trying not to be all doom and gloom, Mike, but yes.
So two things I want to note on that. So there's always workarounds. We've had projects where they needed a year extension or a 6 months extension. They were within 2 months of being placed in service and said, okay, let's do a 2-month extension. That doesn't trigger reissuance. That's good. Because, again, this concept of reissuance for tax purposes is that you have a new, different, changed obligation than what you started with. And so if you have a new obligation before you placed in service, you need a new bond, meaning you need a full new issuance with new volume cap assigned to it as well. So that placed in service thing is a big deal. Engage your tax credit counsel on it as well. The other thing I just wanted to note while I'm thinking about it is I wanted to make a little disclaimer here about these no adverse tax opinions. Those provisions are not in the documents for full employment for bond lawyers. They really are not. What they're designed to do, and I can cite some examples from certainly the early days of the conduit program, they're really designed to as really a safety check, if you would, for your project on this. And so the notion is that, we're going to look at this, we're going to look at it from a tax standpoint, and we're going to say, yeah, that's fine. And again, typically a reissuance with some notice, maybe we've got to do a new TEFRA hearing, maybe we need to supplement the tax certificate, maybe we need to run a new calculation. It's usually not a big deal if we know about it on a timely basis. Many years ago in the early days of the conduit program, we got a call from Bob Larson, who many of you knew, who was the debt manager. Mike, I got a problem. Well, remember that project, the one that's sliding down the hill? It's like, yeah, I remember that one, Bob. He said, well, I just got notice that the seller and the bank and the borrower, they just negotiated their new deal. They're closing tomorrow. Great, congratulations. Well, I'm not sure it works. And sure enough, they had some problems with it, and the way they had structured the reissuance, they were keeping some bonds outstanding, and then subordinating a lien, and anyway, it was a reissuance. They hadn't complied with the rules, and it was going to be a taxable bond. And Bob flagged it because there was a provision that said amendments A, B, and C require an opinion of bond counsel on that. And because we had that safety check in there, we were able to flag it, we were able to check it. Now, that's the one instance I remember, but that's really what it's designed there for, is so just to keep everybody talking to each other. The tax rules are complicated, they're technical in nature, and so I can assure you that as much as we love giving no adverse effect tax opinions, they're there for what we're trying to, if you take away one thing, it's call, full disclosure, call early, have the conversation. That's what it's there for. It's not full employment for us. It's really a safety check. Paul? Sure.
So just to follow along with what Mike said about the no adverse effect opinion requirements that are layered into our bond documents, they are like a safety, as Mike said, in any sort of organization or any sort of engineering project, you will have safeties. So one of the rules with respect to reissuance is that the reissuance occurs on the day you agree to the modification. So if you're out in a corner making modifications with your lender and bond counsel is not involved and issuer is not involved, then you have a problem. The rules also state that you can apply conditions to the trigger date of the reissuance. So the very fact that we layer into the bond documents the requirement for a no adverse effect opinion is layered into the regulations itself to provide us with another safety where we're like, oh, we're not done yet with the modification because we still need the opinion. So you can see that there's a method to the madness, and that we're not trying to run up fees. We're trying to protect the key ground that serves as the foundation for the financing.
Thanks, Paul.
Yes. So I think you guys are hearing the underlying message here is talk to us. Talk to the agency. Talk to your bond counsel. Let us know what's going on. I was just thinking as we're chatting here, talking about problems for your tax credits. What happens if you're not meeting your 50% test? What happens if your project costs have gone, oh man, you're not going to, they've gone up a whole bunch and we're going to have issues. Well, not, like I said, not meeting your 50% test, just for those of you all who haven't maybe run across this before, if you meet at 50% or greater, you get 100% of your tax credits. If you meet at 49%, you get 49% of your tax credits. You do not get your whole tax credits, which can be a horrible detriment to the project. There are other ways that you can kind of structure if you're off by just a little bit, but if you're looking at a severe problem, you need to come back and have conversations with us and let us know that we could be potentially looking at a second issuance for the project just to make sure we meet that 50% test.
Thank you, Hattie. Yes, that's a very, very key component to keep in mind as well. And Mike mentioned this very briefly, but for reissuance purposes, you also need a valid TEFRA. And just to underscore, letting us know early, because sometimes the TEFRA process can be a little bit longer, and getting those approvals can take a little bit of time. Your TEFRA for a project only lasts about 3 years. And so we want to make sure that if you're doing an extension of some sort or reissuance, that we get a valid TEFRA in place if it's exceeded that time. Okay.
Alex, do you want to talk about what the TEFRA is?
Oh no, Mike. I asked you a question and now you did it right back to me. In simple terms, because now I'm not prepared and I'm not going to meet my own trickery here. The TEFRA is a federal tax law requirement for your private activity bond projects, where we have to give notice to the public about what's happening with the project, what your not to exceed amount is, what you're financing, where it's happening, who is owning the project. That's a public notice that goes out to the public. 7 days pass, a hearing will occur that's open to the public, and then we get a required approvals from the governor or treasurer in relation to the TEFRA.
Alex did great on putting that in her review this year.
Oh my gosh, Mike.
Paul, did you have something you wanted to add?
I just wanted to mention that the idea of having a valid TEFRA is not necessarily that you have to re-TEFRA. If you have something called plan of finance language within your TEFRA, your issue date sets the clock on that plan of finance TEFRA, and it's good for 3 years.
Mm-hmm.
So you'll see your bond counsel asking you, or checking when the bonds were issued and looking at the not to exceed amount within the notice and making sure that all the other factors are there. And then if those boxes are checked, you wouldn't necessarily need to re-TEFRA. It's just if you have a very long or extended construction period that exceeds that date, then that might be an additional requirement that might slow down your plan for documenting a reissuance.
Yes, and that's a really good point, Paul, because I think just recently we got notified about an extension for one of the projects that we were doing, and their TEFRA was going, under that plan of finance 3-year rule, was going to be up in under a month. And so I was like, we need to document this fast, execute it now, so we don't have to re-TEFRA this project. So that's a really good point. All right, our next topic is arbitrage and rebate, and this is going to be Robin's show.
All right. I think the last one, am I the last person speaking for the whole conference, or is there another session after this? There's one more. Oh, good. Well, this is kind of heavy, but it's really exciting. I mean, it's arbitrage. How exciting is that? They made a movie about it. Now, not like this movie, but, not like Bonds, but still, it's exciting. If nothing else, there's 3 things I would like for you all to come away with. Number 1, shortly after you issue your bonds or at closing, select your arbitrage analyst. That way, that gives them the opportunity to set that up in their system. You are now flagged for when your requirements are. So even if you forget about arbitrage, if you're going with me, I won't. You will get an email at least once a year that would say, hey, checking in, has anything happened? Because with the IRS regulations, the requirement is every 5 years and at the final redemption date of the bonds. Okay, which leads me to number 2 is conversion. Conversions happen all the time, and oftentimes that has been causing technical reissuances. If you wait until the 5th year, which is the IRS requirement to deal with arbitrage, you're now in a situation that you potentially could be 3 years late on completing your calculations. So whenever you have a conversion, contact your arbitrage analyst. That probably should be number 1, but I guess you need an analyst before you can notify them, so that's why it's number 2. Number 3 is just understand all of your compliance obligations. When you issue tax-exempt debt, that is considered a subsidy, right? And with that subsidy comes a lot of responsibility. And that is in the line of all these compliance items. Arbitrage is just one of those compliance items that you need to be aware of. And if anyone wants some reading, I've got Section 148 of the IRS Code and the accompanying regulations. Guaranteed cure for insomnia, drug-free option. And what you need to do is you need to think about what these mean, what the arbitrage rules mean. You don't need to be an expert, that's why you have me, but you just need to know what are my requirements and what are the timelines. But first, let's go through about what exactly is arbitrage. So when you issue tax-exempt bonds, you receive bond proceeds that are at a tax-exempt rate. What happens is if you invest those proceeds in a yield above the bond yield, now you have arbitrage. And what the IRS says is that is not yours to keep. That never belonged to you. This is not a tax. It's just money that you shouldn't have had. So when we look at arbitrage, there's two different types of calculations we work with. One is rebate, which is the one most people hear about, but there's also this one called yield restriction. And both of those need to be taken into account and be complied with. When we prepare an arbitrage calculation, we include both rebate and yield restriction. Yield restriction actually came first. And what happened was there was some abuses in the system, which is why we have all these regulations, right? So there was these abuses, and so they came in and said, you have 3 years on project money to do whatever you want with your bond proceeds in a permissible investment. After that, you need to yield restrict your proceeds to the yield on the bonds. That first 3-year period is called a temporary period. Well, as you can imagine, time went on, the abuses continued, so then in 1985 they came up with the arbitrage regulations. The arbitrage works the same basic way as yield restriction, except it starts at closing and goes through the final redemption date of the bonds. If you are in violation of either the rebate or yield restriction, you can actually make a payment of that difference to the IRS. And it's called IRS 8038T. You all sign the IRS forms 8038. It's a family of forms, and T is for your transmittal. So we would make that payment, you would make that payment, and then you're in the good graces with the IRS as far as arbitrage goes. On yield restriction, you can also avoid that by just investing in something beneath the yield on the bonds. Making the payment is much easier with this caveat, so long as you pay on time. If you get caught in that bubble of missing an IRS required date, or a conversion happened and we didn't know about it, then you would have a penalty situation. So what actually is included in arbitrage? For rebate, the first two items are very intuitive. That's your sale proceeds. What did you receive from the sale of the bonds? Second is interest. Any interest that you earned on those bond proceeds are subject to rebate. The next two are kind of out there. Transfer proceeds, for this crowd, you're probably not going to see much of those. That is only in the event of a refunding and if there's bond proceeds remaining. Usually by the time you do a conversion, you don't have money left, and it's a non-issue. Replacement proceeds, that is any money, regardless of its sourcing, that secures debt service on your bonds. Okay, it's acting like a reserve fund or a sinking fund. Do not mistake this with a replacement reserve fund or an operating reserve fund. Not the same thing. We're talking about something that is specifically securing debt service on the bonds. If you have a collateral bond and you have that collateral fund, that most likely is going to be subject as basically a reserve. On yield restriction, you've got really the only first two bullet points pertain to you all. One is just your bond proceeds and the 3-year temporary period. The other is the reasonably required reserve fund. If you happen to have a reserve fund, it needs to meet that reasonably required. If it doesn't, if it exceeds that, which your collateral funds often do, then that would be subject to yield restriction. So let's just talk for a minute about what exactly the compliance is. So if you pay off your bonds, you have 60 days in which to pay 100% of any rebate or yield restriction liability. Other than that, the calculations are due every 5 years. And at that point in time, if you owe, you only need to make a 90%. So this is where it comes into play about the whole conversion. I think I'm on mention number 4 on conversion, right? So conversion is very important. If you convert and it's a technical reissuance, that's going to start your 60-day countdown. And then from there, that if once they reissue those bonds, that new bond issue has a new start date for arbitrage, and your 5-year cycle starts over. Within the bond documents in the tax certificate, you'll see something called a bond year. That bond year tends to be the basis for which we prepare our first cycle of calculations. So oftentimes that first calculation is a short period, and that's a good reason why you want to have somebody on board early on to make sure you don't miss your calculations because of that short bond year. Another item I just want to throw out there is you need to keep your bond documents, your investment records, everything associated with your tax-exempt bonds. Forever sounds good, but the actual rule is 3 years past the final maturity date of the bond issue. If they're refunded or technically reissued, it would be, past the final calculation of the reissued bonds or the refunding bonds. So, any questions so far? No? Okay. So the other thing, the challenges of, I just want to mention this too on accounting records. System changes are bad news for everybody involved. Just make sure if you go through a system change that you have everything archived in a usable manner, one in which you can actually gain access to in the future, okay? And then staff turnover. Staff turnover is a big one because I'll do my annual follow-ups, and I'll have 3 people on the emails, and I get bounce back saying everyone's gone. So just make sure that if you do have turnover, if people move on that are in charge of arbitrage, that you have a transition team and just shoot an email saying, hey, I'm moving to another position. This is your new contact. Because oftentimes it's a fun rabbit trail to trying to find somebody who's now responsible for that. So then when we look at arbitrage, you have to keep in mind that it is a compliance for the life of the bond issue. So just because you might spend all your proceeds doesn't mean you're off the hook for arbitrage. You need to make sure that down the road you are not inadvertently funding a sinking fund or a reserve fund of some sort, because then that would bring you into an arbitrage situation again.
Robin, can you talk about, what a lot of our borrowers here in the room have? They've got a construction drawdown bond with a variable rate. As soon as they get the money, they spend it, so they don't have investment earnings. Do they still have to worry about arbitrage?
Yes. So it sounds like a great plan, and it sounds like you would not have anything possibly go wrong. And for the most part, I would say 98% of the time, that's the case. I see them, and there's really nothing to actually crunch numbers on. So rather than a full comprehensive report, you'll get an opinion saying you're in compliance, okay? And just because you're in compliance this 5-year period doesn't mean you're in compliance the next 5 years. It's something that you need to check on. But then there are those other few that flow in there where, at the end they get all of the money and it just sits. Or they were supposed to have reimbursed themselves, and then, all of a sudden, I don't know if they asked for too much or what, but then I've got this balance just sitting there in the trustee statement forever. So that needs to be spent, needs to be cleared out. So there are instances where drawdown bonds are not just a clean shot. So don't get comfort in the fact that you have drawdown bonds. You're probably fine, chances are, but I would definitely take a look at those. The other ones we see is the ones that have collateral, and I don't know, Mike, did you want to talk about that at all? Anything special?
Well, I think we're seeing more. I mean, for many years it was just it's a bank deal, it's a drawdown variable rate with a forward fixed rate, and we're done. But increasingly, we're seeing different kinds of executions, whether it's a cash collateral deal and there's a positive arbitrage play in it, or we're seeing a capital markets execution where there was a discussion this morning on the Hollywood Hub project where that was a rated public offering where you park all your bond proceeds with the trustee, you reinvest them under a guaranteed investment contract. All of those items raise these very issues that Robin's talking about on that. So again, the construction drawdown bond, you're safe, but you need to be really safe. You can't make mistakes here because an arbitrage bond is a taxable bond. So there's a host of issues here as well. But again, we're increasingly seeing other kinds of executions in addition to our traditional bank drawdown structure with the forward commitment.
So moving from there to the end of the process when you're paying off the bonds, usually this occurs in AC rehab situations where there's a purchase of the project and a redemption of outstanding bonds associated with that project. One reason to bring your rebate person in early is to get a sense of whether you're going to owe any arbitrage payments. The reason for that is generally the bond documents on some of these deals are set up to say that you can't release anything anything remaining in the funds and accounts unless you take care of your arbitrage. So that can have you can get a trustee who's refusing to release those monies until they get the report. Now, granted, you have 60 days, but everybody would like to be and can be one and done once on that redemption date or very close to it with respect to the release of funds. So getting your rebate person in saying nothing's owed or nothing's expected to be owed would allow everything to be done on your redemption date and you're all clear and can move on to something else.
That is
Thanks,
a
Paul.
perfect segue into the reporting requirements. So we talked about the IRS requirements, which are every 5 years and at the final redemption date of the bonds, or I should say because oftentimes these technical reissuances occur within the first couple, 2-3 years. So even though you have that IRS requirement, you also need to look at your bond documents. The bond documents may have a different requirement, and your trustees often have a requirement in their trust indenture that says they're expecting an arbitrage report within X number of days after the bond year calculation. So you want to be ahead of the game and know what that is so you don't get one of a reminder letter early is fine because they usually do it 30 or, I don't know, at least a month ahead of time, I would say. So that's not bad, but you don't want to be on that third or fourth request list, right? Usually by then it's past due. And the timing of that, while the IRS requires a payment at 60 days, under the trust indenture, you might see a 30-day requirement, which, by the way, everybody, that is really quick turnaround. So 45 days is lovely. And so by that time, you need to have those turned around to your trustee in order to be in compliance on the trustee side. And I have on here, when does a conversion cause a technical reissuance? But I think this is like the 5th time we've talked about it, so I think we're good. Yeah? All right. So then there are some exceptions to rebate. One of them is called a bona fide debt service fund exception. And what that is it's a fund used to pay debt service. If you start having an accumulation of money in there, it can act as a reserve fund and be subject to arbitrage. So we do the testing on that. So long as it clears these testing criteria, then we're able to exclude it from the calculation under a bona fide debt service fund exception rule. And for Oregon housing deals, I cannot think of any examples where somebody has actually failed that test. So you're all doing good by not accumulating extra funds there. There are also some spending exceptions. I'm only going to mention those in passing. If you're earning positive arbitrage, we would take a look at your issue to see whether or not we can apply any of those exceptions. And if we can apply an exception and you're earning positive, you get to keep that money. It's kind of like a pat on the back for spending your money quickly.
And Robin, I want to underscore that I know we've got some active transactions right now that are public offerings with the math that's showing positive arbitrage. And remember, the arbitrage is yours, but only if you meet a spend down exception.
This next slide, I don't know, it makes me sad. Everyone wants to know if arbitrage ever stops. And it does. Obviously, if you have a technical reissuance or if you pay off your bonds with any type of refunding, that is going to accelerate your final computation date. You also can stop arbitrage if you spent all your bond proceeds, you do not have any type of debt service reserve fund. And here's kind of the catch-22. If your debt service funds continue to be bona fide, the only way for you to know if they're bona fide is if you do that annual testing. So I have some clients that prefer to do that themselves, but I would say at this point, especially with positive arbitrage, most clients will say, I want you to do it and issue an opinion that we are truly in compliance. And then if there are no other proceeds that arise. The next slide shows the type of documents we need, and that comes from your bond transcript. With Mike as your bond counsel, I can go ahead and just get them from him and get those downloaded, and it's beautiful. The investment data, that is something we need from closing through the calculation date. If you have a trustee, oftentimes they will, with your permission, send us the information, or we can get automatic download where we can just download them ourselves. It gets a little tricky when issuers take money off book, where they take it out from the trustee and run it themselves. So that's where things get a little dicey. So if you're planning on doing that, and you've engaged us up front, we can come up with a plan on how to run your records so we can watch for those expenditures and make sure that if you are investing that money, we're properly catching that. And the last slide that I have talks about the common compliance concerns. So these are all generated specifically from Oregon clients where I have, seen here. So this is kind of hitting home, I guess. Failure to keep adequate investment and debt service records available and retaining legacy account systems. So I know I mentioned that early on, but it definitely deserves mentioning again. The technical reissuance, here it is, showing itself. Paying off bonds and failing to do a final arbitrage report timely. Waiting to engage an arbitrage consultant. Staffing changes, we've talked about that, or I've talked about it, rather you've hopefully listened, that if you have any changes, make sure you pass the arbitrage baton, and that gets passed on to me as well. Failure to transfer funds out of project accounts. This usually happens towards the end, or if there's been a reimbursement of something, money gets stuck in the trustee account, and life just goes on and it doesn't get noticed. So when we do the calculation, if we see that, we will bring that to your attention, and then you just need to find a permissible use to spend that on. And then overfunding debt service accounts. That one I actually haven't seen here, but I just don't want it to start happening, so I thought I'd throw that in. Responding to an IRS audit phone call before doing due diligence, and I'll let Alex and Mike talk about that one.
Do your due diligence, call your bond counsel. Yeah, there's perfectly say, let me take a look, I'll be back to you. No, really, I mean, seriously, that we have a whole team of our tax team that deals with IRS audits all the time. Sometimes the letter, frankly, sometimes we've seen them There are mistakes. There was like a whole slew of letters around non-filed 8038s. And there's just sometimes some stuff like that just, it's like, oh, everybody got it. So we all talk among ourselves regularly. There are sometimes some issues that arise that find some targeted audits and otherwise. So again, just engage. Yeah.
And the last one is you have a post-issuance compliance policy. And a lot of people, I don't even think actually know they have it. And it outlines for you, everything you're supposed to do as far as your tax-exempt debt goes. So make sure that you read that and understand exactly what your responsibilities are and follow the policy. And that's all I got.
So just a couple things I'd add. I mean, again, arbitrage and rebate is not the stuff you probably have. It's probably not your regular dinner conversations or cocktail party conversations. Well, except for some of us because we geek out on this stuff. But just again, we want to demystify some of this in terms of these tax compliance things and that. So when we get started with all of you and we get a call from the team at OHCS or from the sponsor, say, hey, we got a project. We said that's great, and we love working with all of you. You'll get an intake form usually from Rayco in our office. You get this detailed questionnaire. It's going to ask you lots of questions. We want to identify, the issues, the parties, just a host of issues. And so you get that initial intake form. A lot of that is tax-driven. And so you'll see that. You'll see the questions on that. That's what all of this conversation is about in terms of making sure the deal is structured in a way that complies with the tax code, state law, program requirements, and otherwise on that. That questionnaire, I believe, is now 2 parts. And so there's an intake questionnaire, and then there's a follow-up tax questionnaire as well. So as you're working through that, that's all the information that we take, and then we generate the tax certificate. And that tax certificate can be a little dense. It's a form document. But if you have questions on that, and particularly if you're the CFO or others that are going to ask us questions on that, we're happy to sit down and walk through that. There's also something called a post-issuance compliance checklist, which highlights some key elements of the tax certificate, including, do you have a rebate analyst selected on that? So again, all of this documentation is designed to ensure both compliance in terms of structuring, compliance through the cycle of the project getting you to conversion, and also post-conversion as well. So our objective is to demystify this, make sure we're all operating with full information, and that we don't have IRS audits and other things to deal with. These projects are tough enough as is.
Well, that takes us to the end of our presentation. We've got about 9-ish minutes left for questions. Does anybody have any questions? Okay, I see one right over there. Wait for the microphone.
So what is the magic trigger to know that we need to reach out to you, Mike?
I would say, well, we just like to chat generally. So, we like to know what's going on. We want to make sure we get invited to the party for the grand opening and and groundbreaking and all that. Before that, really, Mariana, we've closed on the bond transaction. Any material developments on the project and particularly on the debt, call
like
us.
At the very, 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 very first step. What is the very first step that we need to get from OHCS? What is that document called?
So you've got a project, and you're engaging with OHCS on the project. I'm going to let Hattie talk about process and when you should call us.
Mariana, I think you're probably talking about the intent resolution.
Yes, I am.
Which sets the clock for you.
That's right.
Yep. So those are going to be, so the way the ORCA process works now, projects are going to go through and get their recommendation from Housing Stability Council. Then they're going to come to my team. And as your production analyst is working on the LOI, if you have a project that has 4% in bonds, they're also going to be working on that intent resolution to get that presented to our finance committee, usually within 1 to 2 weeks of the project being presented at Housing Council.
So until you get the intent resolution, you cannot call Mike, right? Or you can call him to just check.
Well, I would say just call Mike whenever, but that's up to Mike.
Yeah, Mariana, the intent resolution, we didn't talk about reimbursement. Of course, as you know, the intent resolution sets the clock as to when costs are eligible to be bond financed on that. So I think that really happens before we're typically well before we are engaged or know about the project. I mean, we all talk among ourselves and we see what's on the Housing Stability Council schedule, and it's a small community, so we talk among ourselves. But we typically don't see that intent resolution until the bond offering is actually launched, and then that's part of our due diligence.
Other questions? So the word of the day is, when you're getting ready to convert, talk to everybody and say, hey, we're going to convert in a few months, and we want to make sure we're meeting all the benchmarks, right?
Awesome. Well, thank you so much, everyone, for
I
joining
have another
us.
question.
Oh, never
How do you
mind.
select the arbitrage consultant or the arbitrage calculation person? BLX.
Yeah, okay, shameless plug. BLX is a subsidiary of Orrick, so
Right.
oftentimes for our deals, we'll say, hey, you don't have to select BLX, but they are wonderful. And so that's our automatic suggestion. And Robin, do you want to give more of a pitch?
What Alex said.
Does Oregon Housing have a list of preferred advisors, or is it just through, because Orix is the issuer's counsel, right?
Yes.
Just so we have clarity here. All right.
Yeah, we
OHCS
do
is the
not
issuer.
have a list, Mariana,
Okay.
of preferred, but we're going to defer you to speak with bond counsel, and that's a real partnership there. So that would be our stance.
Yeah, and full disclosure, there are multiple firms that provide this service.
Usually when this comes up, I say exactly what they've just said. BLX, there are multiple firms who'd provide this service. And then when it comes up independently, I'll have people from BLX prepare a bid that would go out to the borrower and its counsel. And then either it's accepted or you find someone that you would like to work with. So there's really no requirement. It's just really finding good people and establishing a relationship with them, as you do with all of the other stuff that you're working on.
Any other questions? All right. Thank you so much.